welcome to yet another edition of Taking Stock. This is the show where we take stock of the week that went by and we focus on all the important cues in the week to come. I'm Sonia Shenoy and with me is Anuj Singhal as always. Anuj, it's been an interesting week. When we started off the week, we expected the markets to perhaps stumble because of the way the Fed didn't move. But by the end of the week, the Nifty protected the 7,800 mark. A lot of interesting stocks saw buying action yet again, the likes of Lupin, Maruti, Infosys. So at least there is a floor for the market for the time being.
Yes, Sonia, I think two things stood out in this week. One was that while last Friday told you that the market had a false breakout, this Tuesday we had a false breakdown. Essentially, the market hasn't done much in this week or even in this month, for example. The month to date, the Nifty is down 1% or flat maybe. So that's one thing. The second thing which this market told us this month is that it's again rewarding some of the erstwhile outperformers. Maruti almost went back to all-time highs. Lupin is almost there, and you're seeing a couple of other stocks almost inching there. So the Nifty is still 15 or 16% lower than the highs, but some of the quality stocks are getting back to their previous highs. So again, that bottom-up stock picking zone or stock picking approach is working. So that's the second key point. And I think the next series is going to be hugely critical. The market will make a massive move in next series, maybe two moves, one on the downside, one on the upside, because we have too many triggers lined up, starting with the policy.
Oh yes, the policy, and then we have the Bihar elections, we have earnings. So October is going to be a very interesting month. So let's get two guests on board. Joining us on the show today, first up is Manishi Ray Chaudhary, the Asia Pacific strategist at BNP Paribas, and then we'll have CK Narayan, the MD of Growth Avenues, into our discussion as well. But first up, Manishi, let me start off with you. You said, India is the best performing emerging markets and it's the best bet, but it won't be insulated from the global slowdown. What's your base case then for emerging markets and for India? Will we fall less than the EMs or will we rally despite the emerging markets falling?
I think, your latter case, that is India would rally even if emerging market falls, that may be too optimistic a scenario. Today we are seeing global risk aversion, and as a consequence, funds are being drawn out of emerging markets and being reallocated towards developed markets. In that scenario, I don't think any large and liquid emerging market can be immune to, the kind of volatility that we are seeing. Having said that, India remains an island, and as a consequence, on a relative basis, I think it would outperform the emerging market complex. And, when I say that India remains an island, I'm really referring to two or three broad macroeconomic parameters. First of all, the big uncertainty in emerging market today arises out of China. India's linkages in the Chinese manufacturing supply chain is relatively limited. We don't even export all that much to China. In fact, if you look at the history of maybe last 3 to 5 years, every country in Asia has become more China-centric. Their final exports to China have increased in proportion quite remarkably. For India, it has remained stagnant. Third, as a consequence of China's slowdown, commodity prices tend to go down, and this is a well-known argument. It's been made repeatedly. But I would still make that point once again, that India remains a commodity importer and a big commodity user in this region. And as a consequence, most of the macroeconomic parameters we look at, current account and fiscal deficit, inflation, etc., they would actually tend to be a lot better going forward. And indeed, we are actually seeing the impact in some of these numbers, like current account and inflation. So I think on a relative basis, India would be much better off compared to other emerging market peers. But, to expect that India on a standalone basis would move up significantly even while emerging markets collapse, that would be too optimistic to assume.
Okay, so that point is taken, Manishi. Let's talk about the India market in particular then. We have the policy on Tuesday. So two-part question. A, will the RBI cut rates? Is that your base call? And B, is it already priced in? And can it still be a bit of a catalyst for the market?
Even about a week or so ago, maybe a week or a couple of weeks ago, we were not quite believers in a rate cut, but now faced with the fact that the Fed hasn't done anything and the inflation decline has been much more severe, much more precipitous than we had anticipated. We think a rate cut on 29th of September is a possibility, and a possibility with a possibly higher than 50% probability. I would characterize it that way. Now, having said that, one rate cut of maybe 25 basis points each, I mean, this, of course, not just the first rate cut, it would be the fourth this year. But it may not really achieve much as far as cost of capital decline to both consumers and investors are concerned. You know, for that kind of a sustained reduction in cost of capital, we have to see a lot more. You know, I'm not saying that that can't happen. You know, in fact, in the near term, maybe over the next couple of quarters, it may happen because the target inflation rate for the RBI, that is almost certainly likely to be undershot, both in January 2016 and possibly even in January 2017. So, you know, I think, yes, coming back to your original question, a rate cut on September 29th is a possibility. But for that to translate into equity performance and, more importantly, investment acceleration, we would need more such monetary stimulus going forward on a sustained basis.
All right, let's get Dr. C.K. Narayan into this discussion as well. Dr. Narayan, welcome to the show. You know, 7,800 on the Nifty got protected this week, but do you get a sense that that could be taken out very soon on the downside purely because of all the big triggers that we have lined up and the global volatility?
No, I don't believe we are going to really take out these lows which we recorded in early September. I think the evidence in terms of, you know, the technicals as well as sentiment indicators were quite substantial at that point, suggesting thereby that we may have definitely put in a significant low. At the worst, I would expect it to be retested, you know, with probably a higher bottom. But I don't believe that we are really going to go down. I think most of the global factors seem to be getting priced in. Even the Fed hike thing now is kicked, that can is kicked down the road for about a month. China, I'm told, is about closed for about 10 days. You have Reserve Bank meet coming up in the next week, and that should probably provide us with some sufficient cheer to go up in the initial part of the month. I think if we make our way upwards in the month of October towards around, you know, 81, 8200, which seems quite probable given that we will also be playing for the earnings when they unfold in the second week of October. I don't believe the market will really go down to break the lows created in September. So I do think a significant bottom has been formed.
CK, hi. That's an interesting point. So would you say that maybe Monday morning would be a good time to take long positions if traders haven't done that already? And what would be your stop loss for any fresh long calls at this point?
I think traders have been a bit slow to take fresh positions in this week, because we had a little bit of extra volatility. Post the expiry, we are having 3 days of holidays. I think a lot of red ink in most of the traders' balance sheets for this month as well as the last. So the willingness to take up fresh long positions is still quite limited. Sentiment rebuilding will take a little while, so maybe we'll have a slow pace start to the next month. So whether we should rush in with buys right at the start of Monday is a debatable question, but the answer is still in the affirmative. I would be looking to build long positions, and here I would probably not venture all at one go, but seek to build it in different lots, allowing the market some breathing room on the downside. I would probably venture into stocks which have shown some upside traction within the month of September. If you look at it from a sector's point of view, IT was a clear gainer. And within IT, I think you have Mindtree, Infosys, HCL Tech Mahindra. These are 3-4 counters wherein one could probably prospect. I think Mindtree is within shouting distance of actually pushing up to an all-time new high And among the majors, it would be the first stock to do so if it were to continue in the next week. And any stock pushing to new highs under conditions like this is always a buy in my set of plans. In the pharma space, I think, which is another one where favorite prospecting happens, I think Lupin is another thing which is shaping up pretty well. Reasonably long correction of a few months, wherein it didn't lose much by way of price, but certainly kind of accounted for the time aspect of correction. And now it seems to be up and running. The news flow is starting to get positive in the counter again. I would certainly take a look at Lupin. The other two stocks from pharma space I would probably venture out with some buys would be Strides Acolab and Aurobindo Pharma, both of which have been pretty steady in and through the declining phase of the market as well. So I think these are areas where it seems to be safe to treat the waters right now. Once we have more confirmation, we can broad base our set of purchases.
All right. Manishi, what is your call on the banking space? I mean, the collapse of the bank nifty has actually broken the back of this market. Should we be prepared for more, or is it a good time to perhaps buy into the banks now?
You see, the two main issues in the whole banking space are asset quality and capital raising, right? And on both these counts, it's the public sector banks which are worse affected than the private sector banks. On the private sector bank side, I personally think that this recent underperformance is actually providing a good buying opportunity for the good quality banks. You know, the ones that don't have a demonstrated asset quality problem, the ones that don't really have a major capital raising requirement right now. On the other hand, the public sector banks do have a problem. Majority of them do need to raise capital, possibly about, several billions of dollars of capital in next 3 to 5 years. Even the asset quality problem is much more pronounced in the PSU banks, even though they have started reporting larger versus, that is NPLs, over the last 3 quarters or so. I personally think that that problem is likely to get worse. And if you look at the sectors in which these NPL problems are concentrated, they're really metals and mining and power. I think government policy, new project negotiation, new tariff negotiation can solve the problem partly in the power side. But for the metals and mining side, that problem for now remains almost intractable. It has got to do with the global commodity price decline and global metal prices declining. China consumes about 50 to 60% of many of these, and with Chinese FDI slowing down, there's no respite from hard commodity price decline. So, on that scheme of things, our preference would clearly lie for the private sector banks. Again, coming back to your original question, we think that on a selective basis, some private sector banks are providing buying opportunity at these levels.
Well, we need to take a break on that note, but lots more market talk coming up, so stay tuned.